heart of where innovation, money, and power collide in Silicon Valley and beyond. This is Bloomberg Technology with Caroline Hyde and Ed Ludlow.
At Bloomberg's World Headquarters in New York.
And I'm Ed Ludlow in San Francisco. This is Bloomberg Technology.
Coming up, yet more earnings coverage for you ahead. We'll break down all you need to know about Cisco. It's the largest maker of computer networking equipment, and it is tumbling after its numbers.
And we'll have more on Alibaba's results as the e-commerce giant falls after abruptly ending a planned spin-off of its cloud unit. Details ahead.
Plus, APEC, it continues in San Francisco. Tech CEOs, they dine with China's president. We'll bring you the takeaways from the executives' dinner. But first, let's check in on these markets. The takeaways are, well, a little bit of mood music shifting in terms of the rampant rally. We've seen NASDAQ off by some 0.3% on the day. We actually had some pretty, well, depressing, shall we say, macroeconomic data. But is that good news in terms of whether the Federal Reserve will go in terms of interest rates? Many feeling that the jobless claims on the rise, many feeling that the factory output on the downward. Well, all of that speaks to the fact that the Federal Reserve cannot hike yet again. And indeed, maybe we'll see cuts in the second half of next year. We therefore see a bid coming into the bond market. We're off by some 6 basis points. Looking at Brent crude, really down 4.5%, let's call it. This as we see the inventories build up. That's more of a signal of maybe cooling demand. What does that mean about global economic growth? Have a look at what's happening in terms of our risk asset of choice. I'm looking at Bitcoin, and still we trade within this general $36,000 level. But we're off by some 3% on the day. Ed, what have you got in terms of the micro?
Well, in the context of China, it's both the micro and the macro. This is shares of Alibaba. The news is that they have decided not to spin off their cloud unit. The commentary is that they have been impacted by US technology export curbs. We're going to dig into that later in the program with our reporters on both the macro and micro China. But the ADRs of Alibaba, the US listed shares, on track for their biggest drop in more than a year. We'll get very specific in that later in the show. Here in the US, Cisco. That is the name that we are looking at. They gave this forecast for the fiscal second quarter ending in January that was well below street expectations. What Cisco said was this is not macroeconomic pressures or headwinds. They have big enterprise customers working through backlogs of networking equipment, and that's why they're not ordering. But those orders should re-accelerate. Do we buy what Chuck Robbins is saying? Joining us now, Piper Sandler Senior Research Analyst Jim Fish. Jim, a neutral rating on Cisco, $50 price target. I was reading your note, and as far as I can tell, you're one of the few that basically is calling a downturn in this networking equipment market. What was your takeaway?
Yeah, Caroline, Ed, great to chat with you again. It feels like it's been only about a month since we caught up on Cisco, given the Splunk deal. But look, I think we agree and we don't agree at the same time with what Cisco's saying. You know, our checks heading into this print and even some of its peers on calendar, like Arista and Juniper and F5 and sort of the networking space overall, we started to see a downtick in sort of what enterprises were looking to order. And really the key theme, I think, for us heading into all these prints, including last night, was digestion. That's the best word you can use. You've had orders from 2021 and 2022 pushed into calendar 23. And you're just seeing that digestion of orders. And meanwhile, when budgets start to get tighter, networking tends to be the first thing that you try to run hotter and squeeze, as if you can get away with it for some time. So we're a little bit skeptical that we could see an acceleration again in product orders in their fiscal second half, especially when you start to think about budgets getting set for calendar 24, roughly about now, with a lot of CIOs and heads of IT.
James, you mentioned that the last time we were on, we were talking about the Splunk deal. Does that, therefore, thesis still make sense? The diversification, not just hardware, networking gear, but getting into the software, getting into sort of longer-term payments from clients?
Absolutely, Caroline. It's a great part of really why they need Cisco. Why Cisco needs Splunk, and overall, it will help with that recurring revenue piece. It'll remove the lumpiness of Cisco's current business, but at the end of the day, even with Splunk, you're still going to have the cyclicality that Cisco has to deal with, given that networking piece just being the biggest part of its business at this point.
Talk up AI a little bit. I mean, they did seem to be saying that the appetite is there. They're building, $1 billion of orders that they see in their line of sight. Is that enough to offset what we see as basically managed decline or managed digestion, as you say, for the next few quarters?
Yeah, I mean, it's a nice narrative to have, but we did this kind of back to basics piece around networking, specifically switching and routing not too long ago. And you dive deep into, where could AI spending on switches be essentially? And you see estimates out there calling for about 10 billion-ish, and even Chuck mentioned that last night, with 75% of it expected to be on Ethernet as opposed to NVIDIA's InfiniBand being the other roughly 25%. But even when you talk about, say, 10% of Cisco's switching business a few years from now being AI-driven, that's a small part of Cisco's networking business when you're talking about a $30 billion plus networking business on its own.
You're talking about wired and wireless. Whatever connects devices moves data from A to B. But what jumped out at me about your note versus others is the end customer. We're talking about, in Cisco's argument, big enterprise customers, right? Not SMEs. And I kind of think of it like the pandemic, right? Coming out of the pandemic, we all had an excess of hand sanitizer and toilet paper. Bear with me. But it seems like a lot of these big enterprise companies, they just have an excess of the networking and routing gear. Do you see that as evidence that Chuck Robbins presented?
Yeah, no, that's definitely showing up in our customer conversations. And as Chuck also pointed out, it's also showing up with some of their largest channel partners in those conversations as well. So look, you just have a glut of equipment sitting there that needs to be deployed. And I don't disagree. It's going to take at least a couple of quarters. And it's more the concern for us is, does this start to stem into the SMB commercial base as well, where that can be actually more macro sensitive as you think about moving ahead, and it doesn't really leave a whole lot of wiggle room still when you think about roughly 30% of their business is that commercial line. And we've already seen struggles on the carrier side that started popping up earlier this year. Cloud, it depends a bit on your exposure to which hyperscaler, let's say. But overall, like, enterprise was essentially that last leg of the stool that was holding most of the space up. And it just, now you're starting to see that down cycle of networking really come about here. And specifically, Ed, to your comment on wireless LAN, keep in mind, wireless LAN has been one of the strongest part of networking over the last year plus. And what we're seeing is, it's actually twofold. One, you've gotten a lot of those access point upgrades already. And so Cisco Meraki, for example, has really benefited, been growing double digits for quite a while here. But secondly, when you look at why they needed to upgrade those access points, it's because of exactly what I'm sitting on right now with Zoom, or in other cases, Microsoft Teams, where that sucks up so much bandwidth at all these campuses and branches that you needed to upgrade those access points. And so now you've kind of gone through that, and those applications themselves are trying to reduce down their bandwidth by over 20% in the latest version. So you just have a slowdown in that space in particular.
It's why I ask if attention's turned to SMBs, because loads of folks use SMBs as their kind of lead indicator for the health of an economy in this context. Jim Fish, Piper Sandler, senior research analyst. Great to catch up. After being rocked by US sanctions, Huawei unveiled a new smartphone in August with 5G capabilities and a cutting-edge processor. A teardown of the Mate 60 Pro revealed the chip powering the device was produced by China's SMIC. This raised questions about SMIC or SMIC's capabilities and the effectiveness of US-led controls. Check this out.
This, at first glance, is just a smartphone. But once you know what's inside, it becomes clear it's so much more than that.
So what really changed everybody's view of this device was what was at the heart of it. The microprocessor that was designed and manufactured in China.
It's at the center of tensions between the world's two biggest economies. The phone made by Chinese tech giant Huawei represents a breakthrough by Beijing as it tries to escape Washington's controls on its access to technology and establish a self-sufficient chip industry. If those U.S. controls had been successful, then a smartphone as advanced as this simply should not be possible without importing key components.
China now is more capable than ever of building advanced technologies.
And it worried U.S. officials who are more concerned about advanced chips going into military equipment than smartphones. It left them wondering, how exactly did China do it?
You can catch that full documentary on the Bloomberg and on Bloomberg.com tonight, 5 p.m. and indeed tomorrow on YouTube. Meanwhile, let's stay with the theme of China. Shares of Alibaba are actually slipping pretty hard after China's largest e-commerce company called off a spin-off of its giant cloud business, blaming, in fact, the US's tightening chip curbs, of course. All of this links. We're pleased to welcome to the show Henry Wren over in London, Isabel Lee, who sat right next to me here. And Henry, I start with you. It feels as though its first dividend just wasn't enough to offset the fact that now the sum of the parts perhaps don't look quite so valuable.
Yes, indeed. So it's a double whammy situation for Alibaba this quarter. So its core business of selling goods to Chinese consumers is not posting the exciting revenues that we've been seeing for last quarter. But more importantly, as you lined out, that the company scrapped its plan to spin up its cloud unit. It's that before that it's going to relinquish its control of the cloud unit and send out the cloud unit as dividend to shareholders, but not materializing for now because the company called off the plan. Although the company did issue a cash dividend, but it's seen as just a minor offset to the disappointment because investors were really expecting that the company would issue this special dividend after the spin-off. And as we know that the cloud is the second biggest segment for Alibaba, so it's definitely a day of disappointment, a double whammy situation for Alibaba shareholders today.
Team, the timing of this is just extraordinary. We're going to go to our reporter at APEC later in the show, but you know, a centerpiece of what happened last night was President Xi and Biden talking about kind of closer economic cooperation while Biden saying we're going to stay competitive. Isabel, what are we learning through these earnings out of Alibaba about the health of the Chinese economy right now?
So this definitely doesn't look good because, as Henry said, many were really banking on the breakup of the 6 baby babas. Optimism was surrounding it. They were saying that Beijing probably gave its approval signal because this wouldn't happen. Many dubbed it as the most radical change in history. And it even looks worse because they cited the U.S. restrictions as one of the reasons why they weren't going to continue this. And as we know, President Biden and President Xi has met their first time in 1 year, and that's as relations between the two nations are, dare I say, at the all-time low. And while there were no really big major headlines, there were small wins, but no one was really expecting a major concession. And some analysts told me that the fact that this meeting is happening is more than enough because the optics is important. But to your point, a lot of investors were really disappointed. As Henry said, it's a big disappointment for everyone. And if you look at Alibaba ADRs, they're now falling to the most in more than 1 year.
And I think it's notable given that actually we saw JD manage to beat, we saw Tencent manage to beat, even with some stiff competition coming from the social apps coming in and the smaller businesses. Isabel, does this really reflect a consumer under pressure, or does this also reflect competition?
I think it's both, but it's really more of the tepid demand that we're seeing. China hasn't seen the big recovery that they were hoping on and that global investors are really banking on after the COVID pandemic. And you could see that President Xi is even trying his best. He visited the Central Bank of China just a few weeks back to show that, he's on top of this. But so far, and we also have foreign investments in China now at their really all-time low. So it's really kind of a complex picture, but it's really not a monolith. As you said, Tencent is doing well, JD is doing well, at least based on last month. But so far for now, optimism is still not evident in Chinese investors.
I always think about Alibaba as like analogous with Amazon, right? You got your e-commerce component, and then the news today being the cloud component. And Henry, you were writing this morning's street wrap for Alibaba. What's the kind of sell side specific takeaway from the numbers, but also the different parts of the biz?
Yeah, so from the numbers perspective, the e-commerce part of the business is still occupying more than 50% of Alibaba's core revenue. However, that part is slowing. So we saw some revival trends in the last quarter, which shows that Alibaba might be gaining its momentum again when its competitors like Pinduoduo, the price aggressor, as well as live streaming e-commerce platforms like Douyin, like Kuaishou, like entering the space and grabbing the market share. But it's not happening once again this quarter because the sales has been a bit disappointing, and for analysts it's a disappointment. And on the other hand, as we said, it's now scrapping its plan to spin off the cloud unit. It's also scrapping its plan to IPO its Freshippo, which is a grocery shipping chain. It's another disappointment for analysts as well. So lots of things to digest for Alibaba investors today.
And as we pointed out, that disappointment reflected in shares. The ADR is down 9%, biggest drop in more than a year, and the stock trading at its lowest level since May. Bloomberg's Henry Wren and Isabel Lee, the dream team, back together. Thank you. Now coming up, APEC continues here in San Francisco as China's president dines with the CEOs of some pretty major firms. We're going to bring you all those details next. This is Bloomberg Technology. Okay, time for talking tech. And first up, shares of HelloFresh falling today after the meal kit delivery company shocked investors by cutting its 2023 EBITDA guidance. HelloFresh was down as much as a record 24%, erasing nearly $780 million of market value. The changes to its outlook come just 3 weeks after it reaffirmed its targets. And Lenovo says it expects to see revenue growth this quarter generated from personal computer demand in China. The world's largest PC maker says it's investing a lot of money into AI-optimized devices, something its CEO says could drive another round of PC replacement. Plus, semiconductor firm Sapien is unveiling its latest artificial intelligence chip for data centers. The startup, backed by South Korean firm SK Group, is ramping up its offering to compete with the likes of NVIDIA and others. Sapien will be conducting testing for major customers before it begins mass production in the first half of next year. Caro.
Well, let's turn our attention to what's happening in your city at the moment, Ed. Of course, APEC underway in San Francisco. And Anne-Marie Horden's been there throughout, talking to some big names in attendance. And notably, there were some big executives in attendance at a dinner with Xi Jinping last night. It's notable we've got some reporting at the moment saying that Tesla's CEO Elon Musk is no longer actually going to be in today's lineup of speakers at APEC. That's largely because he endorsed an anti-Semitic post on X, his own social media site. We'll talk about that later, Anne-Marie. But who have we seen and why have we seen these certain executives with Xi Jinping?
Well, I have a full list of who sat at Xi Jinping's table last night, where you saw a number of CEOs stand up and applaud him, the likes of Ray Dalio, Larry Fink, Tim Cook, all of them. You can see them on the screen there in attendance to meet with Xi Jinping, where, one Republican official, Mike Gallagher of Wisconsin, who chairs the China House Select Committee, said when he was at a protest against the Chinese Communist Party this weekend, said that executives were paying as much as $40,000, or a company paying as much as $40,000 for their CEO to be able to go to this dinner and sit with the president of China. But I think more importantly, we should also look at what the president of China said yesterday. He really struck a more conciliatory, dovish tone. Part of this was the fact that he is dealing with a fragile economy at home. We've seen a huge hit to foreign direct investment into China, and it looked like he was trying to set a path forward to be more welcoming when it comes to U.S. businesses. This summer, Gina Raimondo, the Commerce Secretary, when she was in China, said that she told Chinese leaders that what she hears time and time again from businesses and that China is becoming more uninvestable. So Xi Jinping yesterday said that he has no plans to unseat the United States, and he'd also said that he doesn't want to see China in a hot or cold war. Now, it remains to be seen if this is going to assuage some of these business concerns.
So AMH, on the other side of the table in the negotiation, President Biden was asked a very specific question about whether he viewed Xi Jinping as a dictator. What was his response?
Well, Biden has said it before. He said it yesterday, and he will probably say it again, especially as we get into the November 2024 presidential election. He said Xi Jinping is a dictator, and then he explained it's a very different system in China than the one we have here at the United States. This comment, though, came after Biden fielded a number of questions in the press conference, and then he took some ad hoc questions as he was leaving that press conference. I think the main takeaway from the White House is Biden's not going to back away. I've asked this again, especially as the rhetoric gets heated before November of 2024. But the main takeaway from the White House is they feel that this was a deliverable these two individuals met. And Biden really just wants to get the relationship in a better place where he can pick up the phone in a time of conflict.
AMH, real quick, what's left to come on the agenda while Biden's in town?
Well, waiting to hear from Biden. He's going to be addressing APAC CEOs. There'll be a family photo. And then this evening, he's going to be looking a little bit more forward to the IPEF, which is this watered-down trade deal, not the TPP, but IPEF, the Indo-Pacific Economic Framework. One thing to note about this is potentially some pushback the Biden administration is going to see because the trade pillar has been ditched. It was potentially going to be announced at this forum, and it's not.
All right, Bloomberg's Anne-Marie Horden over from DC in San Francisco for APEC.
Welcome back to Bloomberg Technology. I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco. Two movers I want to check back in on. One for the first time, Palo Alto Networks, a name that we've not mentioned yet. We're talking about largely software in Palo Alto Networks' case. It's trying to jump on this AI bandwagon, but it missed estimates in its fiscal first quarter and lowered its full year guidance, which has hit the shares, you can see, down almost 6%. And revisiting Cisco, right? We've covered it in depth earlier in the show, but the stock is down more than 11%, on track for its biggest drop in almost 18 months. And the concern here is that its outlook for its fiscal second quarter came in well below what the street was expecting. The answer from Cisco, customers are working through a backlog on networking equipment. The concern from the sell side, hold on, we're worried about the health of that market and what the macroeconomic conditions are. But two big movers, similar spaces, and those having an impact on the broader market this Thursday. Karen.
Yeah, and we want to dig in on the broader market, the appetite of corporate spending right now, particularly when it comes to the application of cybersecurity, of defense, and indeed in a world where AI is helping and hindering with all of that. We want to talk with Leighton Bess, CEO at Deep Instinct, and of course you yourself were former CEO of Palo Alto Networks. We were just hearing about some of the perhaps earnings that aren't living up to expectations, even though there seems to be this rampant demand for cyber protection in the here and now. What do you make of the fact that Palo Alto Networks, for example, isn't managing to lean into perhaps that growth in that particular area?
Well, I can't say that they're not leaning into the growth. First of all, I have to commend Nikesh and the team there. What they've done with the company post my time there has been very good. The focus of Palo Alto is a platform play. And the platform play is to really give you a protection around accessing your infrastructure and the threats that might hit it. The other aspects are how do you guard the door? But the platform players are going broad. They're not going deep. And that's where the AI focus needs to come in. Deep Instinct goes deep. And as you can appreciate, I got off my bench to do this because the challenge of AI is really becoming paramount.
One thing we've reflected on this year is that when we're talking about AI in the context of cybersecurity, it's as much a tool for the threat actors as it is for your customers, right? People trying to ward against cyber threats. Who is making the most progress? The threat actors or those trying to defend against them?
Well, I think a lot of people were caught off guard. Many of the platform players have machine learning models, but to really get ahead of the threat actors, you have to have the more sophisticated technology. It's a thing called deep learning. And I won't get into the specific science of it, but it acts similar to a brain in the fact that you've got countless, in fact, infinity parameters that you're checking against, so you can create a predictive capability and get out ahead of the actors. Now, Deep Instinct's been developing this capability for 10 years. So when AI became in vogue in terms of the things you could do from a Salesforce enhancement, customer support enhancement, a lot of the security companies, including some of the ones you noted, were still focused on broadening their coverage, but not going deep into the more advanced, sophisticated deep learning algorithms. That's what we do with the 99% efficacy. But the main challenge right now is protecting data. So everybody's looking to protect data. Everybody's looking to attack the data. You can't fight fire unless you have fire to fight fire. And deep learning is going to be the answer that most of the security companies and platform players are going to have to focus on. That's what we focus from ground up 100%.
Your choice of words there, very interesting. 24 hours ago, we had the Rubrik CEO, your industry colleague, on Bipul Sinha on the show. Have a listen to what he said.
I know Bipul well.
Cyber attacks have gone beyond human comprehension. You have to fight fire with fire. And as attackers are leveraging AI to generate more codes to actually attack you, you have to apply AI to understand what the heck is really going on.
You guys exchanging notes before the
no,
show?
Actually, Bipul he's a very good friend. In fact, I'm an investor in Rubrik. And they're addressing the very big challenge, storage recovery. And it's something that went unnoticed for a long time. It's something we focus heavily on. There are people who are focusing on the EDR, the endpoint, CrowdStrike, SentinelOne. They almost accept the fact that you're going to have a breach, and then they help you clean it up. But you cannot accept the breach anymore. You have to get out ahead of it. And I and Bipul share a lot of views. But the secret is in the technology and the uniqueness of the deep learning framework work.
And let's talk about, therefore, prevention having to take center stage rather than just dealing with the aftermath. Lane, we are at our Heart of Technology show. What is it about deep learning that can go there, unlike other applications that we're seeing from rivals or indeed AI more broadly?
Yes. Rivals and most security companies are using the AI term very loosely, and they focus on machine learning. These are models that are made by humans and trained on millions of feeds. But at the end of the day, the models are only as sophisticated as the people who designed them. The algorithms are not sophisticated. And the best comparison is compare, if you would, ChatGPT to text, deep learning, deep instinct to cybersecurity. It's that level of quantum leap.
Interesting use of analogies there. We really appreciate some of the time that we've just had with you, Bess, Deep Instinct CEO and seemingly investor in all areas of cybersecurity and AI applications. We thank you so much for your time. Meanwhile, coming up, we're going to talk about more of investment, particularly in the world of AI. Menlo Ventures raising $1.3 billion to advance artificial intelligence startups. More on that next with partner Matt Murphy. Ed, what have you got?
Let's go to space real quick. I'm looking at shares of Amazon, modestly lower, 0.1%, but the company actually confirmed this morning that the two prototype Kuiper satellites it currently has in orbit are functioning 100% as intended. That is important because they now can start a broader mass production program to build out the constellation, literally make the satellites and then get them into orbit. Remember, this is a would-be competitor to SpaceX's Starlink, which we've talked about a lot on the show this week, but all going well so far for Amazon's own satellite-based internet future. This is Bloomberg Technology. $1.35 billion. That's how much Menlo Ventures has raised in new capital to fund promising AI startups. This new capital will be invested by its flagship venture fund, Menlo 16, as well as Menlo Inflection 3 and affiliated funds. Menlo Ventures partner Matt Murphy joins us now for more. Matt, I think you'd argue that you got a good track record both of investing in AI and early stage, right? But there's clearly some near-term momentum here. Explain how quickly you raised the funds and where you raised them from.
It was mainly our standard LPs who've been good long-term partners with us. We had positive net dollar retention. which in kind of the world of SaaS means that you raise more, you increased your base of capital from those who were already with you, but we did add a number of additional LPs. I think the reality is that, we've been through kind of a bumpy time in the venture business, but if one can promise the kind of focus around this opportunity, the ability to win, be in great companies and build a portfolio around AI, it's very compelling to new investors and existing investors.
What's been so interesting is instead of VC money going into a lot of these AI startups, particularly the foundational model types, we've seen money come from big tech, ultimately. How have you discerned what is the right sort of reward structure that you need to see from companies that are sort of wrapping around AI, perhaps not building their own models, or indeed whether it's those that are building models? How do you discern what is the best VC-backed company?
Yeah, I think there's really two massive opportunities right now. One is kind of this generative AI stack. So in technology trends, like when a bunch of companies moved to the cloud, we had a whole rebuilding of infrastructure, and that's exactly what is going on here in AI. And then you look at the application layer, and we feel like the application layer is a 10-year trend. There are a bunch of companies that are, the entire portfolio, you mentioned a lot of big companies, we're at this like perfect intersection of technology readiness and kind of CEO company readiness. There's this real move to kind of adopt AI as fast as possible. We'd say that the application opportunity is really a 10-year opportunity, and maybe even some of the best applications will be built in a few years as the technology matures and entrepreneurs' imagination and comfort with deploying these technologies evolves. But right here and now, we feel like there's the biggest opportunity in picks and shovels. So it's those kind of infrastructure building blocks. Obviously, NVIDIA, the LLMs like Anthropic and OpenAI, but there's a whole big middle there that has to happen well for applications to be built. So it's picking models, training models, observing models, optimizing models. There's just a whole big body of work that's coming together right now that's going to make all of this easier and accelerate the application innovation even more so.
You, of course, Menlo Ventures itself, one of the oldest VCs from the Bay Area. Is the sort of founder you want to back coming from the West Coast? Is it now dispersed throughout global opportunities now?
The venture business has gotten more global, but San Francisco's definitely having another renaissance. The Bay Area, we have the most AI talent, I'd say, in the world, and people are kind of flocking back to be part of a lot of these companies. So there are many pockets of venture capital these days. Obviously, New York's been a big hub, some good infrastructure opportunities and application companies there, LA, Seattle, Austin, et cetera, Boston. But San Francisco for AI is definitely the epicenter.
Matt, I want to go back real quick to that kind of 10-year time horizon that you're outlining. It's kind of like Venture Capital 101, but across the startup curve, loads of folks come on this show and say, the reality is 90% of these startups are going to fail, AI startups, 90%. Do you share that kind of outlook?
Well, I think that the numbers are a bit better than that. I think about 50% of companies, fail, don't return capital. There is a gold rush right now, and rightfully, because the opportunity is so big. And just to put that in perspective for you, historically in venture, if you went from 0 to 1 the first year, 1 to 3, 3 to 10 the third year, that's really good by classic venture standards. We're seeing companies in our own portfolio, not to be named, but going from 0 to 20 and 0 to 100 in 1 year. So rightfully, there's a gold rush around this market, and there will, of course, be some things that don't stand the test of time, but we're more leaning into it optimistically that we're seeing signals that this is the fastest moving ecosystem we've ever seen in venture.
Matt, when a founder comes to you with their pitch deck and it's super shiny and exciting, how much emphasis do you put on their access to compute? Knowing like capital is one thing, but their ability to actually, get the resources to build the thing that they tell you they're going to build.
Yeah, I feel like that problem's been a little bit overhyped. I feel like Jensen's going to ramp up production, and a number of other companies are coming forward with GPU capabilities. The main issue right now is people really figuring out the way to do something innovative. I think at the application layer especially, there's a lot of bolt-on things, and there should be, because you can take a current application, apply an LLM to it, and it makes the application smarter, better. When in history we had this opportunity for a computer to do reasoning and writing at the level that it's doing right now. So all those things are super exciting, but there's kind of early stages for imagination of what's possible, and that's really what we're going to see evolve and accelerate over the next couple of years. So I'd say as we look at entrepreneurs, it's less about can you get access to compute? I feel like that'll be solved. It's more about what are you doing that's distinctive that others can't do?
Well, you've made the right bets in the past. I think of Uber, Roku, Poshmark, to name but a few. We thank you so much, Matt Murphy, for bringing on where you see the next sort of opportunities for Menlo Ventures.
Billionaire Elon Musk endorsed an anti-Semitic post on X that attacked members of the Jewish community for pushing, quote, hatred against white people. I'd also point out that we've heard in the last hour that Musk's name is no longer on the lineup of speakers at APEC here in San Francisco. We do not know the reason why his name is no longer on that list of speakers, and here at Bloomberg News we will chase that throughout the day. Let's bring in Bloomberg's big tech editor, Sarah Fryer. What do we know about this post and Musk's response to it?
Well, this post had echoes of the great replacement theory, one of the things that has motivated some of the shootings in the Jewish community of past years. And Musk responded to it saying that it was the truth. And then he built on his comments. He related them to his dissatisfaction with the ADL, the Anti-Defamation League, which is a group that is probably the biggest fighter of anti-Semitism in the world, a nonprofit. And then he brought in his comments back and said, I'm not just talking about the ADL, but anyone who espouses anti-white rhetoric and anti-Asian rhetoric. So I think we have seen a bit more from Musk, his concern about anti-white rhetoric. And of course, this is a very charged time to be saying those sorts of things. There is ongoing violence in the world. He is running a massive communication platform. He has more than 140 million followers himself. So I do think that, when he does this, it is news.
And talk about, of course, that this isn't the first time. It was last year the American Jewish Committee actually sort of really pushed on Musk to apologize previously for a deleted controversial tweet, as they were then known, post once again that made satirical comparisons at the time. And I'm interested in the fact that he in particular has been sort of blaming the ADL, the Anti-Defamation League, for a slump in his own advertising, right? And I wonder to this end, how we try and balance what Musk says is pro-free speech, and actually he said at the time against anti-Semitism of any kind, but yet he continues to perhaps walk a very difficult line.
Yeah, I think when people hear the words anti-Semitism, they sort of cringe and say, "Oh, that's not me." But then when you look at the actual content of his tweets and the people that he's been responding to, remember on Twitter, who you respond to actually affects the algorithm too. The weight of his following when he replies to people, even to say things like or interesting, that can then amplify those voices, and we've seen him do that a number of times. I would say this most recent post is maybe the most explicit that he's been so far about his concern over anti-white sentiment. But I do think that it's something that is affecting his company. Like you said, more than half of advertisers are off the platform. He is wholeheartedly blaming the Anti-Defamation League for that. They had a bit of a patching up since then, but now it sounds like he's back to criticizing them.
Sarah Fryer, thank you for breaking that particular news point down. And we want to keep on discussing the fact that ad advertising revenue has been under pressure at X most broadly. And let's talk about that with Rachel Tipograph, of course, founder and CEO of e-commerce enablement and analytics software provider Micmac. And Rachel, ultimately, are you hearing from any of those clients in discussion that you're having that people are willing to come back to X in its current form, in the current environment in which we see it?
So ever since Musk took ownership of Twitter last fall in 2022, at Micmac, we've essentially seen a 90% decline in brand traffic. In May of 2023, when Linda Racchiarino was stepping in, we actually saw some hope, where brands were like, okay, here's someone who understands brand safety, and we're going to try a few dollars. Not $500,000, not $1 million in advertising buy, but I'm talking about publicly traded companies saying, hey, we'll try $50,000 in Twitter ad spend and see how it works. But Musk is volatile. Yep.
Oh, I'm sorry to interrupt. Please keep going.
Musk is volatile, and every single time he does something like this, we see a massive decline in Twitter traffic. So there is a direct correlation to his activities and brand ad spend.
Rachel, one of the things we've been tracking on the X platform from a technology perspective is a world you know well, which is video. They put a huge emphasis on video as a strategy to bring back creators and then bring back advertisers. How do you see that going?
So this is the interesting thing. When we saw brands retest the water with Twitter, essentially around May and June of 2023, we actually saw strong results. So I can tell you that the investments that they have made in their ad products are improving the ad products. But it's not enough for these brands to want to be associated with his volatile behavior. Brand safety trumps any investments that they're making in their ad products.
And to reflect on Linda Racchiarino, she has really been trying to amp up the focus on brand safety. Have any of the moves they've made thus far made a mark on the clients?
Unfortunately, I feel that Elon's brand is bigger than X's brand. And anything that he does puts a halt to the advancements that they're trying to make.
We want to thank you, Micmac founder, always so to the point, and also bringing us real data on all of it. Founder, CEO, Rachel Tipograph, we thank you so much from Brooklyn. Meanwhile, that does it for this edition of Bloomberg Technology, Ed.
Yep, recap the show on the podcast. And thank you again, everyone that tunes into the podcast, wherever you get them, Apple, Spotify, iHeart, and of course, we publish the podcast to all of the Bloomberg platforms. It's been a really great way to keep some of you connected with the show. From San Francisco and out in New York City, 4 days in the week. This is Bloomberg Technology.